Welcome to our YouTube video, okay? Every week I try to give you an update on what's going on with the economy and what's going on with the stock market because they're not one and the same, okay? Anybody says that the stock market reflects the economy, they're nuts. It does not. I don't buy economies, okay? I mean, how could the stock market reflect the economy when 65%, 58 to 65% of the income for corporations come from overseas? So that's just absolutely silly. Anybody says that, they're just saying that because they're trying to win the election, the Democrats, and everything is so bad. Okay, with a 1% GDP, with 5 quarters of negative earnings. I mean, what else can they say? So they're trying to tie their wagon to the stock market. Say, look, didn't we do a good job? Good job? How can you be doing a good job? First of all, the market has just dropped dead here, just stalled, having trouble breaking out. And because remember, they had their they had right here their their QE1, their QE1, their QE2, their twist, and their QE3, which ended in October of 2012, and that kicked the market up. Without that kicking the market up, it would have been over. And what stopped the market from dropping was, and that's where we are right now, what stopped the market from dropping is the plunger team came in and and they agreed to, look, we've got to take the 5-year treasury and we got to drop the yields. Okay, so we can drop the yields so that we can get the countries, the oil producing countries, out of the bond and into the stock market. And that's what held it up right there. So we had a shift of all the oil producing countries who buy our debt. They shifted from getting a 1.8% interest to where they're getting like 3.2% dividends on the S&P stocks. So they're holding up the market. So they're doing the same thing here right now. So the same thing. So what they've done here is they took the bond market and drove it down. And you drive the bond market down by purchasing bonds. So you drove it down now to 1.5%, which is not attractive. And as I said last week, they rather buy stock market where you got 2.5% in dividends interest, okay? So they have shifted over to here holding the market up. But here's the real danger, okay? As the market, as the yields go down, the interest rates go down, okay, you have the face value, okay, when people buy, you have the face value going up this way, okay? So what's happened though is the oil producing countries are no longer buying the amount of 10-year treasuries that they used to buy to keep it down at 1.5%. That means there's about 354 billion in treasuries, 354 less, okay, in purchases of treasuries. That's not good news, because then what happens is as they push these rates back up, okay, it pushes the rates back up, and what it does is it also drops the face value on these bonds right here. And that means a lot of people are going to get their face ripped off, okay? And that could tip the market over. So the big problem we got is we got PE ratios or multiples of 19 saying, looking forward, that the stock market is worth 19, okay? 19 times earnings. That's ridiculous, because a 19 is a good number. That means and the PE, remember, looks forward, looks out in the future. And that's saying that's one hell of an economy we got going out in the future. But then there's a divergence. How could that be when the yields on the bond are down 1.5%, telling us out in the future we got a butt ugly deal out there? Okay, the economy really sucks. So you got one number telling you the economy's great. You got the other number telling you the economy sucks going forward. So who do you believe? You always believe the bond yield. Now, the problem is they're going to have to come in and do QE, because for a couple of reasons. They're going to do QE because as they keep leaving, we don't have the oil producing countries, as they keep leaving and take their money and go back home with it, because oil prices are so low, they don't have the extra cash. That's causing a problem for yields to creep up. To stop the yields from creeping up, they do QE. By doing QE, they print money, and they get the old printing machine, and they print money right here. Here's the printing machine, and when they print that money, they buy bonds. The Treasury, B does, the Fed, and then it drives this right back down again. That's what they got to do. So that's what QE does. Now, in the meantime, what's going on is that we got another problem with our corporations. Our corporations, starting right here in 2012, okay, when they stopped the QE, they started to do a huge bond buyback starting here. They're still doing it, and they're doing about $650 billion a year. Well, that's a real problem right now because the debt the corporations are having, they got so much debt, they're up to their net in debt. Okay, so and what they've been doing is selling their debt off, corporate bonds, right? Sales. They've been selling the debt off, but at a low rate. Now that they're choking with so much debt because they did so much stock buybacks, okay, that they got a real problem because if they're going to try to sell off their debt, okay, because right now what's going on, they're taking in less revenue, okay, and what they're spending on buybacks, okay, so they're not taking in enough revenue. So if you look at what they're doing with stock buybacks and paying dividends out, that is negative. So their cash flow is quickly becoming negative. So if you got negative cash flow, let's say you got $1 million that's negative, then what they usually do is sell that debt. The problem is they can't sell the debt. I mean, they can, there's demand for it, but it's going to be at too high of a rate. So that's a real problem, okay? So there's two things going on that can start this QE pretty quick. One, the oil producing nations are leaving, and that means the yields are starting to creep up, and that's not good because that'll tip over the bond market, could crash the bond market, crash the stock market. The other problem at the same time, corporate debt is so high, and because they've got negative net earnings, okay, that their cash flow is going negative. So they can't do both. And remember this, it's done nothing really for them. All the stock buyback did is it just reduces the amount of shares out there, okay? So if you have 100 shares that you sell, it's out there, they call it a float, it just cuts it down to 50 shares. Now, what has that done? All it's done is been artificially, it moves the earnings per share up, that moves the stock price up, but it's fake. Because how you got the stock earnings to move up, okay, without profits, you got to move up by engineering it up, okay, by borrowing money. Over here, you borrow money, and then with that money, you go out and you buy your stock. So now you got less shares, and with fewer shares, you spread around your earnings on fewer shares. That moves the earnings up, which moves the stock price up, which is all fake. Okay, so, but what's it done for the company? Nothing. There's no value for the company. There's no value for the employees. Who gets rich is the CEOs because their bonuses are tied to the stock price going up, which is stimulated by all this crap right here, borrowing money at 0% to buy their own stock. So we got two problems: too much debt, corporate debt. They can't keep buying their own debt back now. They can't keep selling the debt because rates going to be too high, and they can't. That's the big reason. The rates are going to be too high, and their cash flow is going to be becoming negative. They can't be paying out dividends and buying stock, their shares at the same time. There's not with their negative earnings. There's not enough money. So you take these two problems. That one problem right there, their negative earnings, they can't sell their debt anymore, and they can't borrow anymore. And over here, you got the oil-producing companies not buying the bond. There's some real serious problems. So they can't borrow, and over here, they got the yields going up because they're not buying. So that's why they need to go in with QE4. In the meantime, what they're doing is to keep the market up. they started to get everybody to start buying the banks. Okay, they're pushing the bank stocks up. So that's going to work for a little bit, but they're going to have to do QE pretty quick. Okay, if they don't do QE, this market could really start tanking because it's not going to hold like it did here before. It's not going to hold. So they're in a real problem. So they got to keep the market up so they can get Hillary elected. Okay, and so they've been holding off doing the QE4, but we're at a point now. I don't think it's going to be much longer. If they don't do QE4, then they got a major problem, especially if the yield prices keep going up and if yields go up, and especially if they can't sell their corporate debt, or they can sell it, but the interest rates are too high. They're really screwed. So that's where we stand. So we're in a real problem right here, right now. The only way this would get us out is we had good corporate earnings in the next few quarters. That's not going to happen because we're not growing our economy. The reason we're not growing our economy because all the corporations, instead of taking their money and plowing it back into tools and plowing it back into machinery, okay, and what that does is that grows your economy, so your GDP, okay. In other words, every time companies take their profits and they or borrow money and they buy tools and machinery and IT spending, technology spending, and more R&D spending. Remember, that's where you get your growth in the economy is by corporate spending. And that's what grows the GDP, but we're only at 1%. So that's a real major problem right there. So our economy is not growing. And the other thing, because they didn't put their money into wages, increasing wages, buying machinery, all that stuff, that our wages are so low now, our jobs are part-time jobs, that the people, when they pay their bills, they don't have enough money left to go out and consume. So that's the other reason why the economy is not growing. So we can't grow the economy to fix these two things. Okay, so the QE is the only thing that's left. All right, so that's where we stand. And like I told my gang, my non-gang members, look, you never have to worry about the market dropping, okay? Because my MV2 always tells you, see the color code? When it changes red, it tells you they're pulling money out. When it turns green, it tells you the institutions are putting money in. See here? So now we're not going to get hurt because we knew we were going long this way here. And then when it just turned red today, we knew to get out. But better than that, you can short. You can make money shorting. So the MV2 is a perfect thing. So if you want the MV2, I have a special on. You just join the gang for $39.95 and you get the MV2 for 4 weeks free for $24.95. Then at the end of the 4 weeks, you decide what you want to do. Well, anyways, I hope this kind of explained to you what's going on, the predicament we're in, and why we can't break out. Okay, we can't break out because we have too much corporate debt, and we can't. In the oil-producing countries, they're not buying the amount of our debt that they used to. That these are two big problems right here. So, well, the only thing that's going to fix it is not new earnings, because we can't get earnings because people aren't making enough money to go out and buy stuff to create profits to grow our economy. So that's it. QE4 has got to be around the corner, and that means that the golds will go through the roof because they got to print so much money that we then would be really in our gold and mining stocks. Right now we're taking profits in our gold and mining stocks. See you on the charts.